Ultimately, all trading still comes down to these 6 points, and that's what we're going to cover. And you've been in my webinars, you know these are the 6 points I know are incredibly important to cover, and they're the ones we're going to cover in this, which is stop losses. Okay, where do we put them? How do we decide where to put them? Entries, how do we know when to enter into a market? Limit orders, do we set a limit? Do we set a profit level that where we take the profit? How do we reduce stress? So the trading psychology part, how much money do we put into a particular trade? And by the way, the answer to that, I'll tell you right now, and I'll come back to it later, is the least amount possible. So we don't lose any sleep if we lose money. Imagine how happier you'd be if your trading was where if you had a loss, you went, yeah, it's small, doesn't matter. Then you might think, well, wait a minute, Alpesh, if my loss is small, surely my trade size is small, which means if I get a profit, I won't make as much. No, because when we have winning positions, we're going to add to them. We're going to take some of the profits we've made and add to those winning positions. So we're going to only risk the money we've made from profits, not our capital, if we can help it, all right? Additional positions, that's the last thing. And let me just quickly, I'll give you an overview before we deep dive into this. Let's just look at the DAX, for instance, and I'm going to draw on the screen. Okay, we need to know in this webinar, we need to know, how do we know when to enter? So that was the E, okay, in Selma, write that down, right? How do we know where to put the stop loss, which is the yellow line? Now, how do we know, do we do a take profit level? That's the limit order. Actually, I avoid limit orders or take profit orders. And I'll tell you why. If you put a take profit order, look what's happened in that trade. You'll be kicking yourself because you would have taken a profit at the red dotted line. You say, wait a minute, the trend went on and on. Write this down. 80% of your profits in a year will come from 20% of your trades. 80% of your profits in a year will come from 20% of your trades. What I'm saying is there'll be a few trades where it just trends on and on. Well, wait a minute, Alpesh. Why can't all the trades that you're going to give us through your secret holy grail strategies, and by the way, they're not my strategies, they're strategies that were taught to me by these people in this book, people like Bill Lipschitz, who was global head of foreign exchange at Simon Brothers, Bernard Opity, who was at Banque Paribas, now runs the Centaurus Fund, which is $2 billion. Bill, by the way, is hedge fund manager of the year 2016. David Kite, who I already told you, Kite Group, in the rich list in the UK. These were the people, they're in the book, so you can due diligence the crap out of me if you wish. My point to you is they're not my strategies. I wasn't born a trader. Nobody's born a bloody trader. They learn off someone else. All these guys would have learned off other people. Oh, why did they tell you, Alpesh? Why did they tell you? Well, you know what? The same reason Warren Buffett keeps telling people how he invests in stocks. He keeps telling people, don't bloody listen to him. The same reason the billionaire Bill Gates has written his books on how he got into software, or Michael Bloomberg, the billionaire, said why he's told people his strategies for success. And even Donald Trump, the billionaire Donald Trump, has told his strategies for success. You might not like them, you might say bullshit, but they do tell you. Because you know what? The strategy for success isn't the secret. The secret's following it and getting capital behind you. Bill Gates didn't have any special strategy. He had capital. He was born rich. Okay. Getting capital, even in a hedge fund, when I set up my fund, I had no capital. I had rich friends and family. Actually, it was largely friends who backed it. That's actually what's the difficult part. So in case you think, oh, Harper's going to teach us how to all be billionaires, actually raising capital is difficult. But I'm going to give you the strategies. That's never been a scarce resource in life. Strategies are not a scarce resource. Scarce resource in life has always been raising capital. So anyway, we're not going to limit our losses, our profits by having reward risk ratios. We're going to instead, at that point, which is L, that's the point we're going to add to our winning positions. And I want you to write this down. Winners add to winners. What does that mean? When you have a winning position, like we would here, and we do here, okay, we add to that winning position. Well, how much do you add? When do you know when to add to it? How did you get to that dotted line? I'll come to that in a second, okay? To come to that and the MMs, because remember in Selma, I've left the two M's out. We need to know this. How did you put your stop loss there, Alpesh? Okay, why is that stop loss there? Now, let me tell you, stop losses are about a principle. They're not about magic numbers, magic scientific numbers. They're about a principle. And the principle of all successful hedge fund managers, and I'm going to wrap, don't worry, I'll wrap all of this up. Some of this I'll be going really quickly. I'll be bringing it all back together. I'm giving you the overview at the moment. The secret of all stop losses from all the wealthiest fund managers, and I didn't invent this. They told me, and if you don't believe me, check the book. You know, sometimes people go, "Oh, I do believe you. Can you prove to us that we should believe you?" And I said, "No, you don't have to believe me at all. Read the book." I mean, you know, like I said, I'm not plugging the book. I get a pound in royalties. the two secrets of all successful money-making fund managers and actually people in life generally when they're making financial decisions. And that's part of this webinar. I want to teach you not just the strategies for making money, but actually this is a window. It's a metaphor. Trading is a metaphor for success in life generally. The two secrets are this. Secret number one, volatility-based stop losses. What does that mean? Okay, and by the way, this is a live trade happening right now. So this is the DAX. Oops, let me go on the right window. Not that one here. Let's just put that so you can see the figures moving in a second. Yeah, there you go. So you know it's a live trade. It's actually happening. Volatility-based stop losses, right? And the volatility-based stop loss is this. The more volatile the market, which means, you know, historically in the recent, let's say, 14 periods, for argument's sake, it doesn't matter whether it's 14, 10, 9, it's the principle that's important. This is how much it's moved up and down. This has been the range, okay, roughly. You only have to be rough, all right? That's noise. That's just how much noise it moves up and down. Now, you don't ever want to be stopped by noise. So you might put the stop loss, which is this green line here. Sorry, this is the entry point. You might put the stop loss 2 times that distance or 3 times. Okay, it doesn't really matter. I prefer 2.75 times the 14-day period. Now, some of you know what the average true range is. Look it up if you don't. I'm not going to teach you stuff you can find on the internet, average true range. Some of you might use your principles of technical analysis. Say, oh, look, you know, that's a recent low, so I'm going to put it there just beneath it. Some of you will say, I will just use experience and be sensible. All right, so you put your stop loss over here, so you're not stopped out by market noise, and your broker, you can do that. Okay. Notice the distance from this entry to this stop loss. And by the way, we just get our computers to do it all. It tells us what the stop loss is, tells us the buy point. So you can see there, it's told us what the buy point is, that green line, told us what the stop loss is, right? So I'm just teaching you this manually, what computers can do for you. Now, then what you do is the same distance of this is where you put, where you're going to add, all right? Or you're going to add to your position. So if the price reaches here, you've got some profits in your pocket, haven't you? Because the price has gone up. So because you entered at this green point, which is this green line, so you're going to have some profits by the time it reaches here. So what we do is we add to our winning position. Why are we adding to our winning position? Right? The reason is so we can start small initially in case there's a loss. See how I'm focused on protecting our losses? We can start small, okay? And then what happens is, I'll come to that in a second, Jitender. All right, then what happens is, when we've got some profits, we can double down or pyramid in, skyscraper or pyramid in, doesn't matter, same size position or a slightly smaller position. You can do that twice. I only have a pyramid twice, okay? Because the reason's this. Imagine you found a trend. Now the position has proved itself. It's a lower risk for you, and you're only risking profits, not capital. And because it's a lower risk trade, you should double down on it, right? And it's like finding oil. If you find oil, you don't put a cap on it and say, I found oil, I'm going to go do another trade. You double down on that trade. We don't have a crystal ball. We don't know, which is why we don't just have big winning trades all the time. Nobody has a crystal ball or nobody has a time machine. Any of those people who there was an ex-footballer who used to go around on the internet. I think he's gone bust now or something. I never hear from him. It was very aggressive to me at an event we did because I said, you know, there's a lot of people bullshitting that they're right 93% of the time. And I said to him, I said to people, I said, listen, go tell him I'll pay him £1 million a year to come work for me if he's right 93% of the time. Obviously, never heard a word. All right. And the reason is it's not about how often you're right. It's about how much money you make when you're right. The point being, a coin is right 50-50, right? That's random chance, heads or tails. We're just trying to be right maybe 60% of the time, 70% of the time. Now, you might say, why are you not trying to be right all the time, Alpesh? Because I don't have a bloody crystal ball. And you go, well, you're rubbish then, aren't you, Alpesh? Well, actually, George Soros, one of the best hedge fund managers in the world, if you want to buy one book this year, buy Alchemy of Finance. His book's as old as mine. It's about 20 years old. It's got a diary in the second half of the book where you'll see he's only right 60, 70% of the time. So what we do in our strategy, and I'll explain all the bits of, because I still haven't gone through E for entry, okay? And we're going to come to that in this. But like I said, with stop loss, we have one volatility-based stop loss. The more volatile the market, the further away the stop loss, the less volatile, the closer the stop loss will be. But Alpesh, if the stop loss is further away because the market's more volatile, sure, you'll have a bigger loss. No, because the other thing you do is volatility-based position sizing. What that means is, let's say the stop loss isn't 20 points away, right? Let's say instead it is 40 points away because the market was twice as volatile, then your position size, because your stop loss is twice as far away, would be half as much. That way, even though the stop loss is twice as far because the market was twice as volatile, you won't lose more money. You're not risking more money because your position size is half as much. Now, the beauty of that is this: in more volatile markets, which is what we're going to have in 2019, you're not risking losing more money. Just because the sea is more turbulent, you're not risking losing more money because your position sizes will naturally be smaller. But Alpesh, if our position sizes are smaller, surely we'll risk losing more. We won't make as much money. No, you'll make more money because remember what I said, it's more volatile. If it's more volatile, then not only does it have a probability of going down twice as far, but it has in the same amount of time, because that's what volatility is, but it has the same probability of going up twice as far in the same amount of time. So you'll have the same ability to make rewards as you did the risk, okay, that you're taking. So that's all fine. And now what's ingenious about that, some of you will caught on really quickly, is you can start with a small position because you can add to your winners. Every stop loss is bespoke to the market conditions and the volatility of the market and the instrument. Fantastic. And in 2019, given the volatility we've already seen, we're not worried or stressed because we're not risk losing more money. Even better. So we still need to cover the M of how do we decide how much money to put in? I mean, how much should we lose if our stop loss is hit? I'll come to that later. Okay. And how much might we earn as a result of that? And the other thing is the E. We haven't covered the E yet. Okay. Which is how do we know when to enter? What was the price doing here? What patterns were you noticing? And we're not talking something as simple and basic like Japanese candlesticks, looking at just one or two candlesticks and going, oh yeah, that must mean it's going up. I mean, seriously, we're going to look at longer term patterns than that. We're also going to look not just at patterns, but also what are we seeing in price formations that we can copy, which suggests, because the market always evolves, everything always evolves, okay, that suggests that the price is likely to go up. So we're going to ditch the old-fashioned ways of moving averages and all the rest of it, and the problems that they gave. And people will sometimes say, oh, you're going to just trade around news. No, news is confidential. It catches you by surprise, okay? It is tantamount to gambling. Like I said, we're not in the forecasting business. I'm not trying to see what's going to happen in the future.